Okay, back to our podcast. So I guess so track record isn't really a critical part for you right now, right?
Yeah, it is not. So many of the funds we do are first-time funds. Many funds are second-time funds. For both cases, first and second time, there is no real track record visible.
Yeah.
Like no DPI at least in most cases, right?
Right.
And even if there is DPI, if there was, let's say someone is raising their second or third fund and there's DPI in the first fund, typically we wouldn't invest in those funds anymore, because if there is relevant DPI in the first fund and someone is raising a third fund, then the third one will be much larger than the initial funds.
Yeah,
so
yeah.
it's
So they're out of your sweet spot already.
Yeah. Track record is not something that we really expect. Sometimes it helps if someone has an angel track record. So if he has shown that he is putting his own money into startups, investing not only in 1, 2, 3, but 30 or 40, and investing on also with some of them, being successfully identifying the right founders, right startups, being in the right network to see those angel investments early enough. So that's a good sign for us. But still, as a fund manager, so something that, let's say, most institutional investors would expect, do you have a track record in your first fund, second fund? This takes 15 years.
Right.
So someone who is expecting to invest in a fund with a real track record can only invest in funds that exist already 10 to 20 years. That's the real answer to this question. So every institutional P, and we are now in Fund 3, right? We are 11 years in the market. Next year, like soon to be 12 years in the market. And still it's too early for many institutional LPs, because we have results in Fund 1, but they want to see results in Fund 2 now. So it takes another 5 to 6 years to have real results in Fund 2. And then we will be 15, 16, 17 years in the market to deliver what they need to invest in us. That's the long-term game we are in. So for us, we don't look at track. We don't need a track. We need we need to be convinced that with the fund structure and the background of the GP and their focus, thesis or regional focus, they might be able to invest into the right founders today to have the right track record, ideally, in the future. So that's, again, maybe a different answer compared to many institutional LPs, but that is exactly what we're looking for. So we're looking to back those funds that have a high probability of being an outperformer in the next decade, and not the funds that have been an outperformer in the last decade, because they will be today raising 200 million or 300 million. We wouldn't be an investor in them, and they will not perform with that new funds. It's because they're too large. So it's we want to be invested in the next performers, right, and not in the past performers.
Yeah. So now I've got like the answer to many of my other questions. So a phenomenon I've tracked these days is also like some of the Chinese VCs, especially VC partners of Chinese VC firms, they also go abroad, like to Europe or to Mexico or to other emerging countries. Of course, Europe is not an emerging country, but like Europe is really a myth.
Some countries are emerging.
Yeah, but Europe is
some
like
countries in Europe are emerging.
A myth to the Chinese venture scene. So typically they will have 1 or 2 partners be all in the European market. So but like it's a new phenomenon, and they haven't really invested in a lot of deals. So I don't really have a lot of samples to evaluate. But I wonder, like, do they really have the unfair advantage to invest in the best, like, okay, uncertain but like high potential, seemingly promising deals?
So what do you think?
I'm not sure. I mean, like, for European companies, they face this question, right? So they would, of course, like talk to the London VCs. They would talk to European VCs. And okay, so suddenly a Chinese VC comes to Europe. Okay, they have a chat. Okay, first of all, they've got a language barrier. So of course, like, already my English level is already like well beyond the average level of Chinese VCs. So that's the first hurdle, the first barrier.
Yeah.
And then you've got like the real talks. And I really doubt that, to be honest.
So let me give you an example, okay? And so the answer to your question is, I don't believe that Chinese VCs will be investing at the earliest stage into the right funders at scale in Europe. That's the answer. But let me give you a good answer to explain why. So let's take US VCs, right? There is no language barrier. They can speak, they're native English speakers.
Sure.
They have a lot of money. They have much more access theoretically to Europe, and they are, in many cases, very bold, right? Business bold.
Yeah.
I don't know the exact American term, but very bullish, bold. They can cover the whole world, right? So, and of course they can cover Europe. It's easy, right? Now that's the perception. If I speak to many US founders, we look at US founders as well, US GPs as well from time to time. Many of them say, we are focused on Europe, but we are also global. Of course, we will cover Europe as well. Now, in reality, do we see US GPs investing at the earliest stage into great European founders? Do we see that at scale? No way.
Not really.
Right? Mm-hmm. No, not really. Right? No language barrier, much more, let's say, longer heritage background than VC. They understand the game well. Really, sometimes great branded funds, right? Or to make it even simpler, Sequoia is investing at seed stage globally. So Sequoia is the best brand in the world. Why does Sequoia not invest in all of the best seed stage founders in Europe then? That's probably the most basic answer, that it's very difficult, even for Sequoia, to invest at seed stage into the best founders in Europe.
Yeah, but now they've got a Sequoia ARC, right?
It doesn't matter. So, Sequoia ARC is the fund fund, right?
No, they do direct investing.
Yeah, but it doesn't matter. So I think what I want to give you as an example is, it's just very difficult for a fund to be a global seed investor, right? It's just very difficult. And the reason why we invest in small funds that are very highly focused in the European ecosystem, because we think that's the way how you can have access either to a region where you win the region, you're a local winner, or to a vertical where you're a vertical winner.
Yeah.
To be in all regions or to be in all verticals just doesn't make sense. Just doesn't work. That's what we see in the whole market. And I'm not talking about Chinese investors coming to Europe. I'm talking about Sequoias coming to Europe and trying to invest at seed stage. Now, this thing changes if you invest in A and B rounds, because there's a lot of visibility for the deal. The founders can raise globally.
Yeah,
so
more financials.
If you raise a larger A round, exactly. If you raise a larger A round or a larger B round, of course the capital market is global. So that's why we see a lot of the US brands coming in after our funds at the A round or B round, investing into leading the A and B rounds of many of the European founders, but not at seed stage. Seed stage, same as I explained with the number of deal flow of first-time managers being much, much, much larger compared to established managers, is also the number of seed or pre-seed companies, founders, is 10 to 20-fold of A-round companies, right? So if a company wants to raise a pre-seed, you and me can start raising a pre-seed round, right? We might be not successful, right? But we might just say, okay, we have an idea, I want to raise a pre-seed fund around, and we're walking around and talking to VCs. Now that's the pre-seed deal flow. Everyone who wants to raise a financing round is a pre-seed round or founder. So the number of pre-seed founders is a multitude of the Series A founder. Why? Because he's raised already pre-seed and seed, and he has already some, and then it's a much smaller number of founders who raise a Series A, and then even much smaller in Series B. So if you are a large VC in the US, of course it's natural that you come into a Series B or sometimes in large Series A rounds, and they have to deploy larger checks as well. So it's not enough for them to deploy 500K in a seed round in Tallinn or in Finland, right? So it doesn't make sense. So that's why I've not seen, and probably don't believe in a situation where large branded VC funds can cover seed stage across regions and continents. And that's the real answer to your question. And also, it's also vice versa, the same thing. Some European managers tell me they're global. And I don't believe in it, but I always tell them, look, show me. Now let's speak in 2 years and 3 years again and show me the deals you've done in US. in SF in New York. And usually it's very, very opportunistic, few deals, and it's probably also adverse selection. So why would a founder in SF take money from a Berlin-based VC if he can't raise in the US, from the right managers, from the right VC?
It's already like a bad signal.
Of course, it's a bad signal. And so that's what I'm saying for the last 11 years. Things can change in the future, but at the moment, I don't see the larger brands being very successful in investing into seed stage companies. There is another trend, by the way, which is that many of those larger brands have started to back small funds. Right? They are a fund of funds. They're LPs.
Yeah.
Sequoia is one of them, for example. They're a fund of fund today, so they are investing into the same funds that I'm investing in to get deal flow from those funds to be able to invest in their A rounds and B rounds. Right? That is more or less a proof for why even Sequoia can't access at seed stage the right companies. It's the same case for many VC funds. I've discussed with them for years why it could make sense, why it's very difficult to source at seed stage across Europe, in all verticals, all regions. Many of them didn't try to do it. I think most of them failed. I would say even all of them failed. All of them failed covering all Europe at seed stage in a meaningful manner means having several outliers at seed stage in your portfolio, or covering seed stage across Europe and across verticals. It's just very difficult. That's
a great answer. So Ertan, do you have like a hard cut? Because here just a few questions left. Okay, so there will be like
I'm good. Let's continue.
10 more minutes or so. Okay.
Yeah.
So why do you always stick to the micro VC stages? So have you ever thought about investing in Series A funds? Because next week I'm also going to talk to a Series A focused VC. And is it pure math, or what's behind that rationale?
I think the most rational answer for us is, and it's related to the last
the management fee part.
No, not really. I think Series A, we're talking about signaling. As soon as there is signaling, which is Series A in most cases, then there is a lot of visibility for that deal, and then there is a lot of competitive capital globally even for that deal. So we think as soon as there is signal, then it's really hard to fight against Sequoia to win that deal. So if you're a local, let's say, VC fund in Vienna or in Munich or in Stockholm or in Paris, right? You're a Series A fund in Paris. Now you want to be a pan-European Series A fund in Paris, right? Now you see a company in Berlin or in UK or whatever. First of all, you have to compete against all the other local Series A funds, right? And second, you have to compete against all the US funds that are able to invest in Series A rounds, right? So, and Chinese, Asian, funds were, SoftBank, for example, were very active in later stage. Tiger at some point was active in later stage, easily deploying money, no questioning. So it's harder to compete. So I think Series A for us becomes more difficult for most of the funds to really get into the competitive, visible deals. And Series A, it's a different stage. So it's, you have more data to look at, you have more team to look at, you have more product market fit to look at. So the deals become, if they are successful, much more competitive compared to seed pre-seed, right? The accessibility of great founders at pre-seed seed, in my opinion, for specialist funds is higher than for the generalist funds at Series A, Series B. There are very few exceptions, though, which are highly focused, highly specialized deep tech funds. But even there, I would prefer a pre-seed seed deep tech fund over a Series A, Series B deep tech fund. Sometimes it's a mix, it's a multi-stage, like seed and A, because these are one of the few areas where there's still not enough capital in Europe, in my opinion. US is different. In the US, you have a lot of capital for deep tech companies at seed and A, but here is still it's still not enough, right? And it's very capital intensive businesses. So you need larger capital. And that's the only case where we would look at maybe sometimes funds that also deploy at Series A.
Yeah.
But we would, if we would see a fund doing only C with a smaller fund, even there we would choose always the small fund. That's the main reason why we look at why we think Series A is very hard. And the other reason is, of course, you have to deploy more capital again, right? The funds are larger. So all the other reasons why we think the probability is lower that you really can outperform.
Okay, so why do you think if a fund focuses itself to only invest in Series A, like they're competing against the US counterparts, like global counterparts, of course, like they've got like great deal flows from continental Europe. It's really been a very hard game, right?
So I think the real reason is, first of all, sometimes in Europe it's easier to raise a Series A fund. I'll tell you why. So a Series A fund can be a 100 million plus fund. If you're a 100 million plus fund, it's easier to raise from public LPs because you're considered large enough to have a large enough team and focus and thesis, large enough management fees to run a company, etc., etc. So risks are lower if you're a 100, 150, 100 to 200 million fund. So much more public money available. The incentive for the GPs high to raise a larger fund because the management fee is high. 100 million fund means 2 million in management fees every year. That's a solid salary for every partner. So the combination of raising easier, so we think raising a larger fund in Europe is easier than raising a small fund in Europe because for smallest end, there is no public money available. You only have to raise private money, right? So for the larger funds, it's easier to raise the larger amounts. And there is an incentive in terms of management fee. Again, one reason why we wouldn't invest, but there is a high incentive for the GPs to raise larger funds because they have much more budget to spend.
Yeah.
So that is probably the reason. And LPs like it. LPs think a larger fund is a more solid bet, which we think data-wise is the opposite. But many LPs think the larger the fund, the more solid the brand and the more money they have, and the fancier their events, the better the AGM, the larger the teams, the websites are more professional. So a lot of things why LPs think, oh, that looks really good, but it doesn't mean that the performance is better. Again, there is, I think, one tweet that I've tweeted a few times is 100% of every fund that was successful raising a fund was successful raising a fund. 100% are successful, but only 10% of those are successful returning the fund. So again, every single fund who raised their fund was successful raising the fund. 100% of the quote is, the worst fund in the world, if they raised the fund, they were successful raising the fund. It doesn't mean that they will become successful returning the fund. Only 10 to 20% will be successful returning the fund. 80% of those who were successful raising the fund will not be successful returning the fund. And I think that's a super important data metric that most of the LPs don't look at. Everyone thinks, oh, this fund is super successful because they've raised 100 million. It doesn't mean they will be successful in returning the 100 million, right? So we are more focused on the returning part and less on the raising part.
Yeah, as well as like the past track record doesn't really guarantee the future
100%.
returns. Yeah, right. So also like back to the fund size, it also reminds me of like if you want to like some of the Chinese VCs. So now like because of the lack of capital in mainland China, and now they're looking to the Middle East part, right? Middle East Asia, or like these countries, and like these sovereign funds or big funds, like they all have the minimum threshold to invest in a fund. So that you must be a like growth stage or later stage fund to be invested.
Correct. That's true. So the larger the LP is, the more difficult it is for them to invest very small checks and small funds, right? That's by the way our business model. So we give those larger LPs a way to participate in those smaller funds by investing in someone like us. right? So they could deploy a larger check in us
Sure.
and participate in a lot of small funds where they couldn't deploy directly. Many of the funds, for example, in our portfolio wouldn't accept the larger check. That's also very interesting. And even if they would accept, the checks would be too large from the sovereign wealth funds to invest in a 20 million or 30 million fund. Now that's a problem, but again, just because they have to deploy larger amounts and the funds have to be larger doesn't mean that their returns will be better. So it's a very simple.
And the returning part becomes even harder, right?
Exactly. So what it means is that sovereign wealth funds doing VC directly in VC funds probably will underperform the markets, the top decile or top quartile returning funds, just because many of the larger VC funds will not be top quartile, top decile. But compared, if you take all the VC funds, if you just take the larger VC funds, of course, some of them will be better in that bucket. But if you take all the VC funds, which by the way, most of the data providers don't do, because most of the data providers like PitchBook and Preqin, they don't track the smallest end. You will not find our portfolio of 50 funds in PitchBook. Most of them are not listed there. So if you just compare it with the larger funds, yes, there will be some in the top quartile buckets. But if you compare it to the total VC asset class, most of the larger funds will not be in the top quartile buckets, just by design, because of fund size. And that means, again, that the VC returns of those large sovereign wealth funds probably will not be very good, right? It's a very simple math behind it, unfortunately.
So like Masayoshi Son really failed through his venture bets, but he just bounced back by his bets on ARM. So like,
I'd like to. So I think SoftBank is and Masayoshi Son, I think he's very exceptional, and I'll tell you why. So he's not the typical investor. He's also not an LP, right? So he's like trying to invest big outcomes, big chunks, big risky bets.
Yes.
So I think personally, and I've thought about that several times. And the other example is Tiger. Tiger tried to do something that SoftBank did for only 2 years. They survived only 2 years doing it. So I think personally, the longer SoftBank will be in the game of doing this, the higher the probability that it will be successful. So, and it looks like they will stay. So I hope that Masayoshi Son will continue. And that's like completely contrarian to what I say in general about MicroVCs and VC returns. But I think like at the absolute other end, if someone believes long-term in technology and that technology will disrupt the whole world and tries to back the most successful companies, even at later stages, but the most successful companies, there might be some cases where he's investing into the next NVIDIA, where he's investing into the next Google, not at the earliest stage, but even if he would invest in Google and at 10 billion valuation, it would be a great outcome for SoftBank, right? So, and I think that's the bet, and I have huge respect. I hope he stays in the market for the next 3 decades with this strategy, and I hope I will be also living in the next 3 decades. And I think he will prove a lot of people wrong, that if you think very long term, even this strategy can be very, very, very successful. That's what I believe about SoftBank. Do I believe that for the majority of growth funds? No way, right? So I think no chance. But if because Tiger is the other extreme example. They tried to do what SoftBank did for 2 years or 3 years, and they stopped doing it, right? And the first signs where they lost money, they stopped doing it, and that's wrong. So SoftBank is standing, right? So it's like not falling, and they have bad news in their portfolio. But I think the longer they stay, the higher the probability that in the end everything will be looking much more successful. He just has to not give up, and also his backers hopefully don't give up.
Yeah, I guess the industry needs these kind of super betters. Okay, so he Masayoshi Son is now envisioning a artificial superintelligence. Not only like AGI, okay. As long as he's not investing in the next WeWork, then we'll be fine.
So not even WeWork. I mean, I don't know. I mean, I don't like the founder of WeWork, but I think the idea of WeWork is not as bad as people think. So I'm still a user of WeWork. Like, I'm super happy client of WeWork. And I think the service the company delivers to founders like me is exceptional. It's great. It's a great product. I can use in any city in the world. There is almost in any larger city, there's a WeWork. So if I go there, it's super easy for me to access to work. It's just a really good product. Same for Uber. I think it's a good product because if you travel the world, it's very convenient if you can book a car via your app, right?
Yeah.
So I think these are good bets, and not every bet will work. That's like venture. And even in the later stage, even if you invest in the later stage in WeWork, it doesn't guarantee that this will be a great outcome. Some of them will be. Some of them, not all of them.
Yeah, indeed, it was really category defining when it embarked on his journey. Right, so this really comes to our last part, which is kind of the silly part of which we will be covering like for each episode. So what do you think is the meaning of life, Ertan?
So for me personally,
Yeah.
I think, so I have 2 kids, and I think family has a big part in meaning of life for me. So educating 2 meaningful personalities for the society is probably, and building this family and continuing to have a healthy family is probably the meaning of life for me. So yeah.
What would you say to your younger self, like just upon graduating from university? It was long ago.
I think I realized at some point when I was older, what I was always missing when I was young was to have something like a mentor. And I'm a kid of an immigrant family, so there was no one in my family who could be a mentor in the network. So I think what I would have probably done different is to search for a mentor when I was very, very young. I think that could have helped to look at things very differently and with a broader perspective, with someone who has really experience. So I'm a mentor to a few young people with immigrant backgrounds today, and I think that was the missing part for me. That's something that I've never thought about it when I was young, and I've never had this idea. But if I would be the younger myself, I think I would try to really have 1-2 strong mentors who can guide me through life.
Yeah, I do believe finding a mentor is quite crucial. Yeah, so like for me, while I'm building YUVC right now, I talk to each guest, each VC or LP each week. So I'm also trying to find a mentor or try to find a guide for me along the way. So who can really like Harry Stebbings found Fresh Destiny, right? Back in the day.
Yes, 100%.
That kind of.
So I think that's important, and I'm still looking for that, by the way. So I'm still, right? So I still have the feeling I'm missing that strong mentor around me. So it's also maybe related. Also, I lost my father very early on. So I lost this father figure very early on. So I think that is still kind of missing in my life, and still missing. I'm 50 years old now, right? I'm a mentor to my own small kids. And I'm a mentor to a lot of people in my environment, try to be, of course, and also a real mentor to 1-2 young people who are professionally in the same business. But I myself, with 50 years, still looking for having this mentor who could help me thinking about some very important decisions in life. It's interesting, but yeah.
Yeah. So actually, last time Christian Dorfer, okay, he has kind of a similar experience than yours. So he also lost his father at a very early stage. So he said it's better if you find a mentor who has done what you're doing, or who has been to the place where you try to go. And yeah, that's something like I'm also trying to ponder these days. So may I ask, so what kind of mentor would you like to find?
It's difficult. I think
Sure.
I think the most important thing is not the experience they have. So let's say, for example, experienced VC. That's not what I expect. I think the most important thing would be to have someone who's very thoughtful and wise.
Yeah.
So it's not, not the experience of 10 years and now 20 years investing in VC or being successful VC. It's about, and you have that sometimes, you meet sometimes people who are extremely thoughtful, listen really well, and are wise with their answers. And that's probably the best mentor I could have. So it's a father figure in the end, right? So
yeah, so hopefully you'll find a mentor who's your type. Okay.
I never give up. So that's probably one of the most resilient people in this business. So I'm still looking for it.
Okay. So what advices would you give to me or give to YUVC? Along the way that I'm starting out like Harry did, starting as a venture media, and along the way, eventually, so my vision is kind of to build a fund or someone like yourself, like a micro VC backer, like in a region, of course, like in a region where I'm good at, where I know the locals, where I can really leverage other skills.
Makes a lot of sense. I mean, you have at least two examples. Harry is probably the most famous one, right? I personally think his media business is much, much more relevant than his investment business. So he's probably much more successful in, building this media business than his VC business, which I don't know, right? So I don't know the details about his VC business, but I would consider him the top of the top in his specific media business. I would not consider him the top of the top in the VC business. Because I also believe that someone can only be good at one thing, not at a lot of things. So the VCs that I back are full-time VCs. They don't do anything else, right? So, and if someone is a great interviewer like Harry, I think it's very difficult, or not difficult, but it's probably more challenging to be also the peak of the peak in the VC game. So, and it's successful anyway. So I would probably, if I would be Harry, I would probably stay just as the media guy and just focus even more and probably build the business to a 10 times larger business in the next 10 years. That's a great business.
But it's like if you are forever a media guy, then the other guys in the industry would also always think you are just a media guy, right? You're not one of us. You're not in the industry.
Yes, right. He could be an investor, with his money.
Yeah.
He doesn't need to manage external money. So he could be an active angel. I think he earns enough with his media business to be an active angel, to be an active LP, right? He could participate in the business, with his own money, right, directly. But that's the case for a lot of founders, by the way, who exited their companies, right? So they don't have to manage external money to be an investor. They can be an investor with their own money, which, by the way, would show their real commitment to the business of investing, right? If they would really put 80% of their earned money back into the business and angel rounds and VC, and VC funds, that's a real commitment, in my opinion. And but coming back to your question, so you have Harry, you have YUVC, Andreas and David, and both are good examples of one covering, let's say, global or more US, I would say Harry, and YUVC covering the European market really well in terms of podcasting, and I think doing something similar in Asia or in China even could be super interesting. And I never, so it's my first podcast with a Chinese podcaster, so I think it could be very interesting, right? And
thanks a lot for your advice. So actually I just missed a part of the podcast, but here are just 2 or 3 more questions which won't take too long.
Sure.
Great. So do you think European venture capital will win in the global race in 5 or 10 years?
No. I don't think that any region will win the race. So that's my core belief. So I don't think that Europe will win the race. It might, but I don't think I don't know. That's the real answer, right? And I would argue that even for the US, it's not a guarantee, because if you compare it to per capita, probably other countries like Israel and Tallinn Israel and Estonia might win over the US in terms of per capita investment and return, right? If it's just absolute numbers, yes, probably it's the US. If it's relative performance, Europe might really win because it's a different market. Now, I'm not looking at the whole continent to win. I'm looking at investing into some funds that will back European outliers at the earliest stage with the small funds, and me being a small fund of funds means that my investors probably will have a better outcome by design compared to many others in the world, but including US fund of funds, just because they are larger. They invest in larger funds meanwhile, and the larger funds invest in larger rounds, higher valuations, they need higher exits. But the thing that most people don't understand is, if you are a great company and founder in Europe, your exit multiple, the exit valuation, is in the US. So if you are a great tech company, the buyer who gives you the highest valuation will buy your company, and that is naturally in the US. So if you do an IPO, it will be a US IPO. No one thinks about a UK or a German IPO. It's just stupid to think about that. If you are a great company, you will exit your company in the US, but you probably have invested at a half the valuation or even one-third of the valuation compared to the US. And that is like the small things. So more capital efficient, smaller rounds, earlier stages, lower valuations, smaller funds, smaller fund of funds. All of that together will, by design, probably lead to the results that we will be very competitive in terms of returns compared to US peers, US fund of funds, or micro VCs in Europe will be very competitive in returning their capital compared to micro VCs in the US. That's the real answer. So it's not about the whole country, because how do you measure that even? I don't know, right? So, but if it's total capital, of course, the US is the winner globally, right? But what brings me, what is my benefit of total capital? What is the benefit of my LPs of total capital? It's nothing, right? So we think it's just what you deliver in terms of, if you are an angel investor, if you are able to invest into the right angel companies, if you're a VC, if you are investing into the right companies, if you have a benefit, if you have a niche, if you have an unfair advantage, and if you find the right founders, and I personally believe that there are great founders in Europe, right? So that's not questionable, because otherwise most of the US VCs try to invest in European founders. So it means there is some talent here, right? And also the whole thing about Europe is too small in terms of market. I don't care. The market is global as soon as you have a great company, right? So no one thinks about building a company for Hungary or Croatia. It just doesn't make sense. If you're a great founder, you build that company and you grow globally. And probably the first country is the US from day one. Exactly. So that's what I believe in. That's the real answer to this question. It's a little bit longer than expected. Sorry for that, but that's what I think. And the last thing about that is, maybe I believe great founders can be created anywhere in the world, anywhere. So there is no, great founders will not be only coming out of SF. A great technical founder building a great technical company can be created anywhere in the world. That's my core belief.
So do you think VC as a business model still work in 5 years? Because it also relates to the secondary market a bit. So everyone is the so-called economists are anticipating a tech boom again, or a tech collapse again, right?
Yeah. So it's a good question. 5 years is a short period. So I think in 5 years, yes, the VC asset class will not change. So within the next 5 years, if there is a collapse, or if there is a strong cycle, I don't know, and I don't care. So the thing is, so again, the same answer. We don't want to be we don't bet on specific topics or verticals. We are agnostic, and we are also not timing the market. So we think that every vintage can be a great vintage, and some of the vintages will not be good. So if you want to time, you might miss the great vintages, and you might be invested into the worst vintages. So we try to not time the market. I will be ideally investing in every vintage over the next 10 years, as I have done in the last 10 years. The idea behind that is that, again, some of the vintages will be huge outliers. So we want to be participating in those huge outlier vintages. That's why no timing, no vertical bets. So we are no timing, agnostic fund, investing broadly into the ecosystem. Now we get that question, what if venture doesn't work, Ertan? What if tech doesn't work? Like today, everyone is more or less convinced that tech is probably the solution to a lot of things in the world, right? Including the CEOs of traditional companies, right? So the car manufacturing company CEOs, they all realize that technology is probably very important for the next generation of car manufacturers. And that's just a very basic example. I think everything else will be disrupted, or they have to be innovative to survive the next decade or the next 2 decades. Now, if tech really will suffer or will have real problems, and if the whole tech ecosystem has a problem returning or delivering, then I think the whole ecosystem will have a much larger problem. So I can't imagine that if no tech companies will be created in the next decade in the European ecosystem, no successful tech companies, I can't imagine that any other asset class will be successful. So it's just, for me, as a fund manager in your European ecosystem, thinking globally also, it's just impossible not having outlier tech companies in not only Europe, but anywhere in the world in the next decade. So it will be part of the next decade. If it will be in 5 years or 8 years or 3 years, I don't know, right? If it will be in London, Berlin, or Tallinn, I don't know, right? But there will be something happening because there's so many founders and so many VCs putting money into founders, and it just would be very unnatural if everything does not work. Because if everything doesn't work, the question is, how does PE work? How does equities work? How does everything else with traditional asset class will work if all tech will not work a whole decade? It's almost impossible to think about that. That's maybe the more philosophical answer to that question. But long term, I think, so I'm 50 years old, and I'm thinking, about long term, will our asset class, the same way like VC today, be existing in 15 to 20 years? I'm not sure. I think this might be not the same thing anymore. So I think the next 10 years, I'm relatively safe in what I'm doing, so I would say. But I think at some point, because it's still a very, the way we are investing, the way funds are built, and the way we are putting money into work, it's very, very traditional still. It's done the same way 20 years ago. So I think at some point this will be disrupted. And to be disrupted, you need more efficiency and transparency in the market. At the moment, we don't have that. But maybe at some point we will have more transparency and more efficiency in the market, and that will change my job and the job of a lot of VCs as well.
So I guess before the venture business is disrupted, I guess there'll be just less qualified professionals in this industry being driven away. But
that's exactly what so that's very good comments, to be honest. So before venture is disrupted, probably a lot of other asset classes and areas will be disrupted first, because it's easier to disrupt, right? So and venture is probably still, if you compare venture to traditional equities, and equities is already disrupted, right? There is no real equity fund manager anymore, because everything is index based and very efficient. Now PE is probably easier. I'm not a PE guy, but easier to disrupt than venture. The know-how needed to invest in early stage technology companies is higher than into the traditional business, where 10 PE funds are competing, because everything is transparent, efficient, visible. You have EBITDA, you have all the returns, revenues, number of employees, growth. Everything is super visible. So it's much easier to have much more efficiency in that market compared to earlier stage venture, which is still difficult to understand which of the companies will be the next outlier companies. Because if you can understand it, that's the next 1000x. If someone finds the DNA, you talked about the DNA. If someone finds the DNA, he can have the next 1000x companies, in a row. And that's probably the answer also why it's so difficult to find that DNA. Or that this kind of DNA probably does not exist. Yeah.
Right, exactly. Thank you a lot, Ertan, for all your great insights and answers to my questions. Really thank you a lot for your time today. And I really enjoyed this podcast, and I also gained a lot of knowledge, and enjoyed it a lot. Thanks a lot, Ertan.
Thank you very much for your time.
I guess I'm really at a great mood or state to be preparing or starting my road trip now.
Have a great time on your road trip. Thank you for inviting me. I think we have almost 2 hours. So spend 2 hours. I really enjoyed it. Thanks for the questions also, and have a safe trip, my friend.
Yeah. Thanks a lot. Yeah, this is also like the longest podcast I've also recorded. So so before publishing, we always send a copy to the guests, so that of course we will delete some parts that might not look that good.
Of course, yeah.
Of course, also to give it a review, so that you can see if you want to move away a part of this cut or something like that. Okay?
Yeah, sure.
Okay.
Happy to. Yeah, no problem.
Great. Thanks a lot, Ertan.
Take care, man. Take care. Thanks for the invite. Take care. Bye.